For more on today's sell-off, let's bring in Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Mike, great to have you back with us.
Thank you.
We've already said that you say don't buy this dip. So when will you know when the selling is pretty much done? Where are we right now?
Well, I'd like to see price action change a little bit first, right? So the title of our note was really, look, we're in a bear market. Don't trade it like a bull market, right? I mean, the price action has changed. It's been changing all year. This is not the first dip that failed, by the way. We've had multiple dips this year that have not been rewarded by buying them. And so it's just different, right? And it all stems back to liquidity and the Fed and the tightening of financial conditions. That's our thesis all year. It's been this rolling bear market. We finally got to the big tech stocks. So I actually think we're about 90% of the way done with the valuation damage that's going to happen. What we're waiting for now is just the earnings going to be cut, right? So why are stocks selling off? They're selling off because they know that next year is not going to be great, that the earnings numbers are too high. And that's our margin call. So we think that's going to take time because companies are not going to come out and just take numbers down between now and January. You got to wait for January, then you got to wait for April, then you probably got to wait for July next year. It's going to take time. It's like a drip, drip, drip. So it's going to be a process. We're going to wait for price action to tell us that it's better. And then we want to see the numbers come down, and we want to see the Fed say something more dovish that maybe they're closer to being over.
Well, we're already through earnings season, so whatever guidance cuts we're going to get for 2019 have almost pretty much happened, if they have happened, and they probably won't happen until they report the fourth quarter. So, U.S. strategists, you come out around this time of the year, beginning of next year, and you set your price targets for the S&P 500, which is based on an earnings forecast. So is it your expectation that those will come down meaningfully across the board pretty much? Because that's what it sounds like needs to happen as well.
That's right. So they're done for the third quarter. Nobody guided for 2019. Typically, companies don't guide for the full year until January, which is why the numbers only came down about 1.5% for 2019. Pretty minor. So we do think that'll start in January, but we think it'll be slow because companies don't like to deliver bad news. They usually deliver bad news when they're forced to. And analysts usually don't kind of move ahead of that. So we're going to be, our forecasts for next year are going to be below consensus on what we think earnings are going to be. But the market doesn't necessarily believe what Mike Wilson believes. It wants to know what the consensus is. That's going to just take some time.
Is that a third-person reference? Because we'd like to do that on the show.
Well, what does Mike Wilson believe right now in terms of earnings? I mean,
I think they're going to be up a couple percent at best, 2-3%.
Couple percent.
Yeah, and the street consensus as of a couple months ago was 10-11. Yeah. Now it's 8.5. So it is coming down. It's coming down. And interestingly enough, in October, growth stock estimates for next year came down more than value stocks. I mean, our big call is just a rotation to value from growth, not because value is so fantastic, but because growth was just too expensive, right? And
so if one of your concerns is liquidity concerns, and part of that is driven by the Fed, when you see the Fed funds rate sort of coming down when it comes to expectations for various rate hikes, whether it be for December, which has come down to 70 or 69%, depending on what reading you want to look at, and then next year taking out the March hike and going to June, I mean, does that make you a little bit more constructive on the markets as you see that come down?
I mean, the two big issues for us were financial conditions and that growth was going to peak. So the financial conditions thing is still tightening, right? And the Fed is not backing off. By the way, we also wrote that we don't think they should be. They're doing their job. That's the problem, is that people expect the Fed to bail them out, but they're not. That's not their job. Their job is to slow the economy when it overheats. And believe me, the economy is overheating. That's the trick, is people like, oh, the economy's great. Yeah, but we know what happens next. It slows down.
Third person thing confuses me. That's Mike Wilson over there, right?
I did introduce him as Mike Wilson of Morgan Stanley.
Like three guys.
You know all of us for years. That's Mike Wilson.
It throws me off.
Yeah,
anyway, your question to Mike Wilson.
I'm going to ask him a question. I keep reading, I keep hearing this is the greatest economy in the history of our republic. And we know that the stock market and the economy are two entirely separate things. So given that backdrop, why should the Fed slow down?
Exactly. So that's why we're stuck. And the market knows that. And I think the market knew that all year. I mean, what changed in the fourth quarter of last year, which got us a little bit less bullish, and by the way, a year ago I was the biggest bull on Wall Street, how things changed so quickly. But the bottom line is that we thought the Fed last fourth quarter was moving in a much more deliberate way than they had since the financial crisis. Rightly so, right? We got a fiscal tax cut. We got obviously full employment. We had CPI, core CPI moving towards 2%. So they should have been moving in a more deliberate manner. I just don't think that people believe them. And now that they've moved in that direction, well, here we have it. We have an asset correction. It's the normal course of business. This is very natural at the end of a bull market that needs to consolidate. Okay.
So just to button this up, Mike Wilson, you like utilities, healthcare, energy, and banks, and you like this even though there could be some more downside ahead.
Yeah, well, look, that's a very value-oriented bet, right? So it has a defensive skew to it. We did upgrade a lot of defensive stocks in the summer. So remember, value has defensive stocks and cyclicals. And the one thing I will say is that the cyclical stocks have already discounted an earnings recession. That's the trick. is that these stocks have discounted a lot of bad news already. They'll be the first ones to recover. Once the Fed stops, look for those stocks to lead.
Mike, thank you.
Thank you.
Great
Thanks for having me.
Isn't it great having Mike Wilson on?
It is.
Wilson,
All three of them.
Morgan Stanley.
And if I were Tim Seymour, I would say that if the Fed actually stopped hiking in March, I'd be very concerned. And again, we want to see that. I realize that rate expectations for the December Fed meeting are slipping, but they're slipping also because they could probably then just go in January. Bottom line is, I think if the Fed steps out of the next two cycles, it would be a significant indictment on markets. I would also just point out really quickly, European markets are what concern me more than anything. I'm talking about Italian bond yields. I'm talking about European consensus politically. I think that is breaking down, and markets are not pricing that in.
You buy anything on this pullback that we've seen?
The only thing I grabbed today was a regional bank. It was actually Regions Financial. And interesting that he brings up energy because Encana was one of the other names. It's been energy's been absolutely just powered to the downside. I mean, it's unbelievable the bludgeoning that they've taken so far. But Mike is talking about most of the damage is done. So that's what makes this whole thing tricky is if we see another push to the downside, is it on big volume and how far does that go?
Yeah, I mean, listen, he's talking about most of this correction. When you think about what's going on, yeah, our economy is overheating, but you know what's not overheating right now? Asian economy, European economy. I mean, we could be on the cusp of a global synchronized slowdown here. And that, maybe U.S. will be that best house. We've used that, in a bad neighborhood. We've used that a lot over the last 5 years. But one group that you do not want to be in, and I forget your regionals, is the money setter banks here in the U.S. And they've
totally outperformed.
Okay, Tim. I mean, maybe on valuation.
You have to go to a commercial.
Can you think of this late in the cycle and the way that they have performed over the last year? Can you think of a scenario why they should outperform other than based on value?
JP Morgan.
I mean,
JP Morgan is
okay, fine. Buy JP Morgan all day long. That's the one.
You done?
No, I'm not. I mean, because, yes.
Well, when you say outperform on what time?
Like the last 2 weeks.
During
at least the past month.
No, I'm saying relative to itself. In terms of companies that are off their 52-week highs, JP Morgan is 6% off its 52-week high. Most of the market is about 22%
Goldman Sachs about $10 away from the day that
look at the camera,
Trump
not at me. We're in a split
in
screen.
No, it's straight on. I mean, you're a good-looking guy for your age, so I like to kind of get a really good look at you.
Jokes are one way to get out of a serious conversation.
I'm going to pull the plug on this. Last word.
Simply, banks have the most defensible position in terms of they just had record earnings. Their valuations are the most in line. And frankly, if interest rates are going higher, they're going to be more profitable until there's a credit process. Notice I'm still in the box. You're not even there.
No,
you're back.
You're out.
All right.
It's over.